Welcome to the Jay Martin Show. If you are new to the show, my name is Jay and I'm an investor looking for the smartest home for my cash. That's what we do here. And my guest today is Tavi Costa of Crescat Capital. Now, I love chatting to Tavi because he puts his money where his mouth is. We begin today's conversation talking about the biggest misconceptions in the macro landscape and then segue very quickly into how he is playing those as an investor. What I mean is where he is allocating capital right now. As always, if you enjoy my work, I publish a weekly essay every Sunday where I dive into the psychology of decision making. The most important tool in every investor's tool belt is the management of their own mind. We jump into the heuristics, biases, and blind spots that lead to the best and worst decisions investors can make. If you want to join 40,000 other investors on this journey, hit that link right beneath this piece of content. But here is Tavi Costa. Enjoy.
This is Jay Martin.
Okay, here I am with Tavi Costa. Tavi, it's great to have you back on the program. I appreciate you making the time.
Thanks for having me. Looking forward to this.
Me too. Okay, so here's where I want to start. I want to start with high level, your perspective on economic outlook, because I'm seeing kind of two stories play out right now, kind of like a decoupling, if you will, between what the media is telling us our life is and what life is for a lot of people. For example, last week, I saw three stories, Wall Street Journal, New York Times, Financial Times, all putting out big headlines about how we've mastered the soft landing, right? And this recession may not even occur. And if so, it'll be a lot softer than people anticipate. Simultaneously, we're looking at things like auto loan delinquencies hitting all-time highs, credit card application rejection rates hitting all-time highs, commercial real estate transactions are kind of non-existent. And it seems like the boots on the ground experience is very different from the one being broadcasted in the media. Where do you land, Tavi, you personally, on the recession, no recession, hard landing, soft landing approach?
I think that the fact that a hard landing hasn't happened just yet doesn't necessarily change the probability of one happening, meaning I think, if anything, when we analyze most of the indicators that tend to precede recessions, I think all of them are basically, warning signals right now. Yield curve inversions already happened. We've seen already 90% of the treasury curve inverted. We've already started to see contractions in most of the fundamentals of companies, while sales have somewhat got, I don't think they're as profound of a decline. If you looked at most of the bottom line of companies, I think that's pretty clear that we're seeing that already. But then you have some other things that are part of the kind of divergence that we're seeing, this major divergences in markets. And I'll explain a few of them. The credit spreads being so suppressed, we're still seeing volatility being very low. And it's not in line with the potential of a hard lending environment that we can get into. So I think there's opportunities on the short side. We've had a cycle that is playing out very similar to the tech bubble, where there was the initial bust, and then markets ran up again and actually retested the prior highs in October of 2000. And that's really when we saw everything fell apart after in the later parts of the year. Potentially that could be the case here. I've never seen a time when the Fed tightened monetary conditions so much, and we don't see those lagging effects become very pronounced in the overall economy. So I'm very concerned, because I think valuations are too extreme, especially if we are entering a period where cost of capital is supposed to stay higher than historically average. And also inflation is, to me, a real underlying issue in the overall economy, being driven by a lot of important factors. And so all that should be, I think, ultimately cause a compression of multiples in equity markets. But also, we're still seeing the development of tangible assets and commodities doing well. And it's interesting because it's different parts of that market are working at different times. Right now, we're starting to see oil played out again very nicely. Oil's been breaking out recently and so forth. Recently as well, we saw old gold doing, reaching the bottom in September of 2022, along with silver. And now we've had some more volatility recently. But it is interesting that all of those markets are still sort of strengthening over time. And I think this is not the end of it. I think it's the very beginning. And you can see even Brazilian equities doing better than US equities, although we've had this AI euphoria. Brazilian equities are outperforming the S&P. So sorry, it's a lot to unpack, but I think that we're going to have a hard landing scenario. And, I'm in that camp, and I think it could happen, in the next 6 months or so.
Yeah, no, that was an excellent answer. And I do want to unpack a bunch of it, starting with where you started. You said, you said people maybe make the assumption that if the hard landing didn't occur, maybe on schedule, right, that it might not occur at all, right? And we make this mistake often. Investors often make this mistake where the event doesn't happen on the predicted date, so they make the assumption it just won't happen, when in reality, nothing happens like that in the markets. You mentioned maybe some opportunities on the short side, and also, a compression of multiples in the equity market. So, the S&P is kind of on a 6-month tear right now. Is that where you're looking for short opportunities?
I do. I think there are some, very interesting ways that their markets are offering asymmetry today in terms of optionality in derivatives because of the suppressed volatility. Apple, for instance, is a great example. The stock is volatility wise so suppressed, and in the implied vol of put options and other things in some of the mega caps are just not in line with, this increase of market cap that we've had recently is not in line with the improvement of fundamentals. I'll give Apple as a great example is, if we look at free cash flow 2 years out, it's supposed to be flat. So why do we justify $1 trillion worth of improvement in market cap just in the last 6 months or so? I think it's just, this is not, I think, there's some really big distortions today in the stock market in the US. And funny enough, I just don't understand why there's some businesses outside of the US that look incredibly cheap. I mean, why pay 40, 50 times earnings on a business in the US when you can pay 2 times earnings outside of the US with tremendous growth potential, given the resource rich aspect of some economies like Brazil and other places. And so I can see that there's and that is just not just the equity market. I mean, I've never seen a time when the US standard of living or cost of living in the US and Canada as well has been so high relative to other parts of the world. Right. And so, one funny place to look at it, just look at the Big Mac index. When was the last time the Big Mac index was showing US Big Mac be more expensive than Brazilian Big Mac? And we haven't seen that in ages. And so it's one interesting takeaway, but do that with housing, do that with stocks, do that with bonds. And so it is, to me, it is an opportunity, but also very scary what's going on in equity markets in the US. And so the treasury market is sort of what holds the key for the entire economy in the US and the global economy. Even thinking about just recently, we've had what happened with Japan, right? They've had to basically buy unscheduled bonds of their own government to suppress rates. But if you look at the interest rates in Japan, it only went up by, 0.65 basis points. That's it. That's what's causing all this madness. And so that really speaks volume about what's happening in terms of the leverage in developed economies worldwide, not just in Japan, but in the US too. And so I don't understand how, anyone would justify paying those high multiples in a world where the only way to justify really this is we're going to enter another 10 years or so of high growth and low cost of capital, which is probably quite the opposite of what we're probably going to see here.
But investors typically fall for the same patterns every time, which is to say what happened over the last quarter will probably happen during the next quarter in terms of equity performance. High prices kind of self-perpetuate, right? Like investors chase high prices into higher prices. And, I had a guest on the podcast, David Hunter, on maybe 4 or 5 months ago, and he was making some very bullish predictions for the S&P. And my audience was destroying him in the comments, saying there's no way, there's no value in the underlying assets. Why on earth would the S&P take off running? But his case is real simple. He said the underlying asset doesn't matter. right? Investors will just chase prices higher and then chase those higher prices, and that self-perpetuates. And, we are in a period maybe in the equity market where emotion is the biggest driver of share performance. And a lot of investors are really just trading share prices, not actually investing in any underlying asset. It's the last thing on their mind. All they're doing is trading share prices.
Look, it's been very difficult to be a bear, right? I mean, and it's easy to say that because in the last 10 years or so, even this new generation of investors have completely unrealistic expectations for returns in assets that they invest in. And so I think I'm not sure if this is really sustainable what we're seeing. At some point it will, I think we're going to see some issues. And I personally think it's going to happen a lot sooner than most people think. That doesn't mean that doom and gloom scenario is necessarily a bad thing for investors. I think there's a lot of ways to allocate capital smartly and things that are really cheap. There's no point to be, like I said, to be paying 40, 50 times earnings on a company when you can, it's not all about returns. It's about risk adjusted returns, in my opinion. We all want to go to bed calmly, but I think there's fundamental problems happening in the treasury market that it will spill over the global economy. And to me, it's not just a treasury market. It's really all sovereign bonds. The amount of issuances that we're seeing today of treasuries is really unprecedented. When we went to business schools ourselves and went to learn about the risk of investing in bond market, we learned about interest rate risk, inflation risk, the default possibilities, but we really didn't learn about the risk of issuances, the supply side being, flooded like we've seen recently. And this is a problem we've had of almost like a monetary and fiscal divergence in policies. While the Fed is trying or attempting to reduce inflation by raising interest rates and shrinking their balance sheet side, the government's doing the opposite. It's spending money right and left. Even if we reduce or exclude interest payments from all the overall picture, we're spending about 20+% of GDP today on fiscal spending. Not a lot of people know that. And we're running a twin deficit that is already at the same levels that is comparable to the worst parts of the global financial crisis in 2008. And so why does that matter? Because it's just compounding the debt problem at a rate that is really alarming. And those rates of compounding will essentially create the increase in issuances that somebody has to buy those treasuries. The Fed is not buying. And so at what point something breaks here? We keep saying financial conditions are not tightening, although the Fed has been raising rates. But when I looked at interest rates being where they are, and we're seeing so much debt that it's going to have to be rolled over very soon, at what point does that really start to impact the global economy? Just the federal debt alone, 45% of the federal debt will mature in less than 2 years. They have to reissue that debt alone. And 15, 16 months ago, interest rates were at 0%. So who's going to be, what is that going to do to interest payments just, 6 to 2 years from now? That is a big question. And so I had a chart the other day where interest payments is already surpassing defense spending. So you're starting to see that that's going to start to constrain policymaking in general. And I think that's a much bigger question is, who's going to take care of the treasury market? I think we all know the answer. I hope I'm not surprising anybody, but it's probably going to be the Fed. And so the fact that we're experiencing such a intricate macro environment, and at the same time, I see people so skeptic to invest in gold, commodities, other tangible alternatives, is shocking, really. I mean, if you say no, nobody's a skeptic. Well, look no further than the 60-40 portfolios that own zero gold allocation today, or zero commodities, or zero Bitcoin, or zero real estate, and so forth. And so to me, that's going to have to change in 5 to 10 years.
I did see that chart you put out, and I think as of last I saw, tax receipts, 14% of tax receipts were just going to interest payments alone. Um, Now, what's your take on a Fed pivot then under these circumstances, Tavi? Would you expect, another 25 basis point rise and maybe that's it, and then maybe a pause? Do you have any thoughts and speculation on rate increases, pauses, or pivots?
Well, I think the Fed is not going to cut rates until something breaks. I don't think they will deliberately start cutting rates because we've had inflation improving or anything along those lines. Um, and so if you looked at the euro dollar curve, is just a way to measure what the market is expecting, which is now, very actually the largest price or rate cuts expected in history. I disagree with that as well. I think I think inflation develops through waves. I've had many charts showing that. People used to come up to me and say, well, this is a chart of the 70s. This is nothing like the 70s. We didn't have debt problem back then. Well, look at the 40s. There was also 3 waves of inflation in the 30s and 40s coming out of the Great Depression. So what does that tell us is that, well, we got to be aware that there are base effects and there's just psychological impacts in the economy when you have inflation getting out of control once, that then it develops through over time. And so, and by the way, this is not a US phenomenon. You can see that in Brazil, in Venezuela, Turkey, other places too. So understanding that as a model, I would expect that inflation is very close to or in the process of bottoming. And you can see that already with commodities beginning to rise. And the base effects that we're going to see as well through this year, starting this month. And break evens is starting to move higher. 10-year yields are also being forced higher, not only through the issuance problem, but also inflation expectation. And every day I go on the newspapers. In fact, there's one right in front of me showing, protests on the streets and, workers saying we don't want to settle for a 30% increase in wages. We want to settle for more. So, clearly there's something very embedded in the economy right now in terms of inflationary forces. And that's going to have an impact on Fed policy. And so people thinking inflation will go away and the Fed will be able to pause and actually even cut rates as markets are assuming now, I disagree. I don't think that will be the case. I think inflation will learn that it could not only bottom, but potentially even start to reaccelerate to the upside. Oil can be something that can lead the way to the upside on that front. Remember, it's 73, 74 or other periods when you have stagflationary environments. I think that's the big risk right now. And some parts of the market are still pricing an environment where it's more like 08 and 2000. And this is very different than that. This is not a deflationary shock at all. So I hope I answer your question, but I don't think the Fed will deliberately cut rates anytime soon.
I publish a weekly newsletter every Sunday. If you would like to subscribe, hit the link right beneath this video. Now, I'm an investor, but I don't write about managing money. I write about managing my mind. Without question, the hardest and most important part of allocating capital through volatility and getting some back. If you want to read my newsletter, hit the link right beneath this video. I know you'll love it. Now back to the interview. Enjoy. And it would be hard. I mean, you mentioned oil prices. You mentioned gasoline prices, right? Which are suddenly on a bit of a tear, as is diesel, and gasoline prices are probably the most like right in front of the public in terms of understanding inflation numbers as possible, right? Everybody fills up their car. They're looking at those numbers. We're up 30, 40 cents per gallon in the last few weeks alone in some US cities. And then the lagging effect of that is the increasing cost of diesel goes into the manufacturing of everything, right? And so I don't mean to like compartmentalize this one ingredient, but when I see that, I can't help but think we're getting queued up for another significant wave, inflationary wave. Do you agree with that? Do you think that we're probably looking this winter at some pretty inflated prices?
Well, not only agree, but I'm positioned portfolio-wise to capitalize on a reacceleration of inflation. I think investors should be doing that. And if that's the case, it doesn't mean the Fed won't cut rates in the future. That I just want to make that clear.
Okay.
But if that curve needs to be adjusted by inflation reaccelerating, then we shouldn't be expecting record rate cuts a year out, right? Because probably that's not going to be the case. Now, what's important back in the 70s, and I'm using the 70s, but you can look at the 40s too. Inflation, when it reaccelerates, it tends to create downward pressure in the equity markets. And that's because of the expectation of what the Fed will have to do to stop inflation from growing. And so would that be the case here? Most likely. This is why I think there is one separation or a disconnection in the market right now that is really interesting is NASDAQ relative to 10-year yields. And this relationship is important because it really started in 2021 when we started to see this inflationary forces become more and more pronounced and more established in the system. And with that, correlations began to change. So you saw bond markets collapsing. You started to see some actually businesses that are not profitable beginning to be impacted as well at the same time. And there was a very clear correlation between 10-year yields and NASDAQ, where if 10-year yields are rising, cost of capital was rising, NASDAQ was being impacted negatively. But recently, we've had this break of this correlation where 10-year yields continue to move higher. And although NASDAQ is moving higher as well. So something has got to give. And in my opinion, the separation really started. Well, it's not my opinion, it's factual. It started when ChatGPT was announced and so forth. And so this AI euphoria has created an idea of the markets that perhaps won't really materialize anytime soon. Yes, AI is an important breakthrough and so forth, but would that be something that will create the level of productivity in the short term? That's a key word in our expression. In short term to fix the problems that we have, I don't think so. And so I believe some companies have improved fundamentally, like Nvidia and so forth, justify somewhat of that appreciation we've had. But companies like Apple increasing by $1 trillion or so with no improvement in fundamentals, and there's plenty others, and some of those actually have to roll their debt very soon, like I said before. So I think that that's going to be squeezing margins soon, and this is the whole reason why inflationary periods cause multiple compression, is because you tend to see either markets prices have to catch up with fundamentals, or fundamentals actually get squeezed by wages and salaries growth, material cost growth, and so forth. That causes margins to be smaller than people were expecting. So I like to look at history. I don't like to just believe in a narrative that is just things are going to be rosy just because of those new breakthroughs and technological advancements. And I appreciate those, but I think history is more important here.
Well, you mentioned you're building your portfolio accordingly, setting up maybe some defensive plays. Talking about capital allocation right now, Tavi, where are you looking?
Well, on the long side, I continue to be very focused on tangible assets in general. I think there is a place for gold as a defensive asset. There is a place for more inflationary assets. Still, oil looks attractive, not as attractive as it was 3 weeks ago or so, but it still looks attractive. And I think it will continue to go higher. Nat gas is something we own as well. Agricultural commodities are clearly starting to form a trend to the upside. And the real asymmetry to me is on owning resources in the ground. But then, that's a separate discussion, is more of an activist approach of owning companies that have, a real, either already have a resource or are very likely to have one. And the reason for that is because when you look at that part of the market today, everything is priced for failure. So it's very hard for investors to distinguish which ones are high quality ones. And if you're an investor actually for the long term, this is a fantastic opportunity. It's a way of buying a business that is priced for failure, that potentially have much higher odds of having a major discovery or something along those lines. So that to me is where I spend a lot of my time on the long side. I also think Brazilian equities look very attractive today. South America in general does too. We're seeing a construction boom being caused by green revolution, by also what's happening in terms of this onshoring of manufacturing, that I think it's an important one. We're seeing defense spending and all those things. All of those changes are going to cause a construction boom. Even in the US, think about housing markets. We're talking about how things are expensive. How do you fix a housing market being expensive? Well, you got to build. And so, we're going to see a lot of those things happen in the US and other developed economies. And I find it hard to believe that a place like Brazil won't be playing a key role strategically and geopolitically to supply most of those resources to the rest of the world. And we've seen this in the past. In the early 2000s, when China was doing that on its own. Now imagine the G7 economies doing all that this time around. So I think there are great places to invest in a country like Brazil today. We've been focused on that front as well, looking for pullbacks and adding more. Recently, we've had one. I'm adding more to the portfolio. I like steel producers, commodity producers. I like the banks look really cheap. So there's no shortage of things to be doing. But obviously with the mindset of, things can get difficult here. So how do I hedge those positions? And if it is treasury markets, but really to me, there are better ways to look for businesses that have long duration aspects that will be impacted by that. Happy to go over that too.
Okay. Well, I want to dig into your conviction in, I'll just call it like raw materials and or hard assets, depending on how you want to look at it. You made a comment about, buying commodities while they're still in the ground, and why that's, a good play right now because of the valuation. These companies are priced for failure. These are companies that have proven they've got an economic resource, mineral resource, but it's beneath the surface still. They have not extracted it yet. These companies are crazy cheap, in my opinion, right now. So I'm allocating a lot of cash this direction as well. Let me tell you what I'm doing. I'd love to get your feedback on it. How about we do that? So right now I'm pushing a lot of cash towards mid-tier gold producers and smaller gold producers for the same reason that you like these companies, because the market doesn't care about them right now. And I'm looking at companies that are producing maybe 150 to 250,000 ounces per year with a path to 500,000 and a vision to 1 million. And I like this sector right now because I've got decent cash flows. The market hates them. And so I'm walking in with zero competition. I'm mainly focused on precious metals, even though I have conviction in the thesis for base metals and renewable energy metals. But I guess my concern about we haven't really experienced the coordinated global recession that might occur. I'm maybe a bit more hesitant to jump into the copper, the nickels, and then all the various plays in the lithium, the cobalt, etc. So right now I'm mainly focused on precious metals for that reason. I think that there might be a better buying opportunity in the near future for your coppers and your nickels. Let's start with that. What do you think about that thought process?
No, I think it's a interesting way to look at the world and look at opportunities. I personally feel more comfortable with base metals in general. I think there's certainly a need for it for many reasons. I think a lot of people in your podcast and YouTube have shared that in regards to the construction booms that we may see across the globe. But more importantly, when you think about the cost of production and the cost to build a mine today, that is going to be an important aspect. And the reason why that middle part of the industry that you're referring to got so impacted recently by the increase of capex and expected capex that is supposed to be for those projects to come into production and so forth. It's the main reason why those valuations are so cheap. What I liked about the exploration side of the market, number one, is because if you are a believer of a bull market that is a secular market for commodities in general, those are the parts of the market that obviously carry more of higher returns, although they have higher risk. And so to me, that is an attractive part just for that aspect alone. most of the billionaires in this industry of mining have made their money in exploration mostly, right?
Yeah.
And then after that, they spend most of their time in development and production side. And you can name many of them, from Ross Beatty to Tom Kaplan. There's a long list of those guys that basically made all their capital in the side of the exploration. So to me, taking a hybrid venture capital approach into that side of the industry is even more attractive. Another way to think about this is, how much capital do you need to find a major discovery? If you're in the oil industry, it's hundreds of millions of dollars essentially for you to start a kind of exploration project. In different parts of the world in the mining space, you're probably going to spend, you can spend $3 to $5 million and make a major discovery. And so knowing that a lot of those potential discoveries, they're not already resource based businesses, they're just priced as if they don't have any odds of finding anything. And some of those companies, when you look at the work they've done, they have an incredibly high probability of finding major discoveries. And when you think of that way, and you spread the risk across many of those companies, owning a very large percentage of them over time through a fund or through your own network, I think this is probably one of the most attractive ways to kind of ride the wave of most of the billionaires in the industry. And so to me, I think we're going to see the need for major discoveries in the future. I can't imagine that part of the industry will be left alone. So I do think that all parts of the industry will do well, especially the one you're invested in. If there is a real cycle for gold and precious metals, I've never seen a gold cycle that doesn't happen interconnected with other commodities. I know you're concerned about copper. I've suggested to look at a chart of gold and copper going back 30 years, 40 years. And you can see it's essentially the same chart. Yes, there's more cyclicality, but they're kind of the same chart. If you get into a 2000s period, copper is going to go up in value too. It's hard to believe gold is going to go up and copper won't. So commodity markets are all interconnected. And I'm only saying that because I've done the same research, and I was concerned about even agricultural commodities. And guess what? Agricultural commodities and gold are kind of the same chart too, going back 30 years or so. I'm happy to send those charts to you. And when I saw that, to me, it was, if I have such a high conviction, and I do think there's so many drivers macro-wise for precious metals in general, I have to at least take a look at the other commodity sides. And, I think there's many reasons to believe that the same will happen, particularly if you are the view of an inflationary period, at least higher than historical standards. So there's a lot of ways to skin the cats, and some folks will tell you that don't mess with exploration because it's high risk. There's, and certainly I'm not trying to paint a picture that it's an easy part of the market to be invested. But I just happen to be connected with folks that I think are, probably the best exploration geologists we've seen in the industry, and so I'm gonna make a leverage bet on them essentially, and I think this is not only working out, but I think will work out very well over the next 3 to 5 years.
Yeah, well, and as you mentioned, your partner Quentin is one of the most respected geos in the business. That's for sure. Okay, I'll stick with the copper thesis there. The copper minted the world's first billionaire, Jacob Fugger, in like the 1400s. Really? Yeah. My audience can fact check me if I'm wrong, but I believe he was the world's first billionaire. He made his wealth from copper mining. He was like a German merchant, small time, but in the 1400s. And he made his money from copper. So where are you looking in terms of copper projects then, Tavi? Are you, I see the world as maybe a bit more fragmented than it used to be. If I've spent my entire life in the era of globalization, that era might be coming to some kind of a close, and we're going into some era of deglobalization, whatever that looks like, but maybe more, harder battle lines between enemies that used to coordinate aren't going to coordinate any longer, which might make the location of strategic resources like copper a lot more important. And so walk me through your your process for identifying opportunity in the copper sector?
I think it's very similar to the gold process, by the way. It's always looking for scalable projects that are in areas that we've seen mines being developed. And also there is a path towards production at some point. And a lot of them are very, very early projects for obvious reasons. And so I would say that copper, the difference with gold is certainly the fact of in terms of the supply side is not an issue to find copper. The issue is to find high grade copper. And so, we focus very much so on grade, and it has to be very much economically viable. And it's not easy to find those. It's been very difficult to find large copper stars. But when we do, they're usually massive plays. And so in terms of jurisdiction, I think majority of our copper plays are in some parts of Canada, US. We have investments in also Australia, and South America is a big part of our portfolio too. I think most of those base metals are in those parts. Gold, it's sort of in the same jurisdictions. Brazil is another one that we have. Bolivia is one jurisdiction that I think is a contrarian opinion that we have relative to the rest of the world. A lot of people have very skeptical views about Bolivia. I do too. And I think there are many reasons to believe in that, but there's a net change that is becoming more positive over time. And even speaking with other major companies in the area have attracted us to be more, to at least not only invest, but really look at other projects that there are available in the area. And, it's just a very unexplored region of the world. And there's a lot of those places across the globe, not only Bolivia, but other parts of, especially South America, that I think look really attractive. I think South America, you have to be really careful, not only looking at the political changes, but watching the commodity market. The reason why Venezuela became so difficult to invest and all the turns that we've had over the years was also related to the oil prices collapse that we saw in 2014 all the way to 2018, 2019, and so forth. And that certainly exacerbated those political issues. Right now, I'm not sure we're seeing that environment. And so that allows us to take I guess a kind of positive outlook and start looking at those areas to invest. And so we take political issues very serious, but I think every asset has or for every risk there's a price. And so certainly there's some projects that are starting to look more attractive. I hope I answer your question, but that's sort of the way I'm approaching this.
Yeah. And are you looking at lithium projects at all right now? Have you allocated any cash this direction?
No, I mean, there's very small amount of capital that we put into lithium. The lithium market is rich. I mean, it's very expensive in general. I'm a sucker for things that are unloved that not a lot of people are talking about. And I guess lithium doesn't fall into that category. It's the first question I get from every institutional investor that wants to invest in our funds or people that we speak with. And so I think there's going to be great developments there. There are a lot of investors putting capital into businesses that are probably never going to be a mine. And I think there's two types of lithium projects. And it's very similar to most base metals, really, where you get projects that will be able to become mines and others that just won't, just because of the metallurgy issues and others. I mean, if anybody who is more of an environmentalist and believes in lithium in general, I've suggested to go watch how lithium is extracted, and you will probably change your mind immediately about the whole thing. But so we've had opportunities to invest in some high grade projects in different parts, actually in Brazil and Canada before. Okay. And they end up being great investments, but I don't think it's the main focus of Crescat. I think there's great value to be found in nickel, copper, manganese. I think there's tremendous value to look at other electrification metals that will become strategic over time. along with lithium. And I'm not short lithium or anything like that, but I think there's better value opportunities in other parts of the mining space.
Yeah, I appreciate that. And you're right. It is definitely a hot subject and attracting a lot of retail interest right now. Look, I appreciate your critical eye on this, Tavi. It's, something I always say to investors when they're, making decisions in the market is every time you buy equity in anything, you're having a disagreement with somebody, right? The seller, right? You're disagreeing about the value of that share price. You're making the assumption that it's undervalued and going to go up, but they're making the assumption it's overvalued and going to go down. And so, you need to be able to answer the question, what do I know this person doesn't, right? And that's a hard question to answer when retail is flooding towards anything right now. We're seeing that, all through the S&P, and I wouldn't say so much in the lithium market to the same extent, but absolutely. I mean, I think even at the BMO conference, for the first time ever, there were a handful of car manufacturers at that show, and they're looking for lithium companies, right? Which we haven't seen at commodity investment conferences ever. So anyways.
You made a good point, by the way. Just a final point, sorry.
Yeah.
But back in the 90s, what really financed most of the technology space or sector was venture capital, the private equity funds. You almost need some sort of capital source to create an evolution in one part of the economy. And it is important what we've seen so far with car manufacturers entering the mining space. I also think it's interesting what's happening with the gold space in terms of the big major companies almost moving away from gold production. And if you look at back in history in the 70s and early 2000s, production for gold was falling as gold prices were entering a secular bull market. So, the skepticism towards big major companies towards a metal or something doesn't necessarily mean it's the end of that metal. In fact, it might be the main reason why you should be focused on it. And today, I think even energy companies might start getting more involved. We've seen Exxon and some others starting to get involved with lithium, but other metals too. And I think that's interesting because those businesses are printing money today, and they are likely to be getting more involved with mining over time because of the economics of it will look more and more appealing as metal prices rise. And so I think we're gonna need that capital source, and it's probably going to come from auto businesses, but also energy companies, and potentially even some sovereign money too will get involved. I mean, Saudi Arabia getting involved in a large way with mining. I think that's the beginning of a trend, not the end of one. So I'm also looking towards what's going to be that source of capital that will sort of unleash those big trends in the commodity space, and especially create that value opportunity in those companies of the mining space overall.
Yeah, and I'm glad you mentioned that because I think that's a major headline, the Saudi Arabia development, right? MBS building a bunch of cash to deploy into the mining market. It's significant. It's very significant. And when we talk about, watch the big money move, right? Are you following the Cobalt story at all? This is it's Silicon Valley's newest unicorn, right? $1 billion valuation, spearheaded by Bill Gates, Richard Branson, Mark Andreessen, Ben Horowitz, probably some others. And they're looking, their mission, as I understand it, is to create a Google Earth, a Google Maps of the Earth's crust, right? Mapping out the mineral distribution around the planet with the intention of discovering cobalt, nickel, copper, and lithium deposits. And then they're now actively invested, I think, in over 100 early stage base and critical metal companies, which is another interesting thread to follow, right? That's big money from a jurisdiction that historically does not invest in mining, assembling a huge capital pool and attacking the resource sector. It's interesting.
Those things are going to be, I mean, sometimes I walk in places like New York and I think about it. Wow, how much money people made on real estate or some different ways that they made money back in those days, and looks so obvious today, right? Walking in those big cities, and you clearly there was a trend that a lot of people miss, and some others create a lot of wealth. And I keep thinking, what's that today? And staking ground in really prolific ground in different parts of the world for with the exploration hat and really trying to accomplish those big discoveries is something that is still available. And it amazes me that there's not enough people spending time staking claims in different parts of the world that look really attractive. And so that's what I spend most of my time with the companies that we invest in, because I think that's the next real estate, really. So why not spend most of your time there if that's what you believe? So, but that's sort of the way kind of I think about is sort of, it's looking back in New York and seeing all those big buildings and that look so obvious today. They were great investments, but back in those days, I'm sure a lot of people missed it. And I think I don't go to a restaurant or a bar and hear people talking about, investing in resource businesses today. I hear people talking about Bitcoin and AI and all sorts of stuff, but I don't hear people talking about that. And so that, as a contrarian nature that I have, at least, and I think you do as well, it's just immediately comes as part of my radar to be more interested in that part of the economy and that part of the world. So, anyways,
I love
to
that.
me, it's really attractive what's happening right now.
Look, I want to thank you for coming on the show, Tavi, and chatting with me. And I want to send everybody to Crescat.net, where they can find a lot more about what you do, including a lot of content that you publish and write. Definitely worth a follow on Twitter. Best charts in the business. But Tavi, thanks again, man. I appreciate your time.
Thanks for having me, Jay. Appreciate your time as well.
Thank you for tuning in. I hope you enjoyed this conversation. Now, if you want to take the next step, I publish a weekly newsletter and it's free. There's a link to subscribe right beneath this video, and you can join me and 50,000 other investors weekly for this exclusive content where I share my key action items and takeaways from conversations just like this and plenty others. Thanks for stopping by.